Hey everybody, Chase Cologne here with Merit Holdings. I hope you enjoyed the last video regarding cash offers for your home. And in this video, the topic is going to be using a payment structure in order to purchase the real estate. So in this particular example, this is actually going to be an example where we use commercial real estate as the actual product type. However, this can be applied to different. This can be applied just as simply to your house. This particular property, guys, is actually it's not in New Jersey. It was in Monticello, Illinois. It was a mobile home park, which we are big on currently. Now, I'll jump right in. Again, this can be applied to any type of real estate whatsoever. This particular property, guys, the seller was asking for 310. Now, I don't know if you know much about Monticello, Illinois, but the land out there, this was a 3-acre mobile home park with about 17 lots, as you can see here. And basically, I'll keep it simple for you. The land is very cheap out there. You're talking like $2,000-$3,000 an acre. However, this property was realistically worth about $150,000, and this gentleman was asking 310. Probably because he knows that so many people are overpaying for mobile home parks today. However, you can see here our maximum purchase price was $278,000, and you might say, well, why not 280? It's again because we work backwards in order to find this number right here. So, what was going to happen here, guys, was we were going to acquire a mortgage. This is really the important part here. So you could ignore everything else, but I want you to focus right here on this column right here where it says debt, the purple part. So this is important. What we were going to do was we were going to acquire first mortgage of $168,000. Okay, and this property needed a little bit of work. So you can see here up in my notes there were a few things that we had to work into our business plan in order to satisfy the first lender. So he was going to the gentleman was more than willing to give us $168,000 first mortgage. We were going to put down $20,000 capital up front. And what this was going to allow us to do was we needed to keep our payments low enough in order to make money and keep the lender happy. So for every dollar that we had coming in on this property, every dollar worth of debt that we had on this property, we needed $1.50 to actually qualify for the loan. So this was a lot of moving numbers around, and the way that we finally were able to do it was say, hey, how about this? You give me $168,000 first mortgage. The debt on that will be $13,500 every year. And what about the other $90,000, right? So the other $90,000 right here is going to be carry back by the seller. Actually, you can see here it says seller carry $90,000 with a 5-year balloon. So this gentleman was actually, he was very set on the price. So we knew that we would have to negotiate other terms of the deal. So here's what happened, right? I proposed, and he actually accepted this. That he take back that $90,000. Basically, what that means is that for and look, 5-year balloon means that in 5 years I owe him $90,000. He's basically holding a $90,000 mortgage for me. Now here's the thing: I was not able to pay him in the first year. So these were my terms. If we're looking at this right here, Okay, seller carry means that he's holding the mortgage. You can hold a mortgage. It's called a seller carryback or an owner finance mortgage. It is secured by a note, same as a bank. So that the IOU, which is the instrument that secures the debt, is equally as enforceable as if you were the bank. Now, there are regulations regarding this. This is why you hire an attorney. It's 100% legal. It basically stated this note that he took back, that in the first year he would receive no payments because in the first year we needed to keep the debt, what's called the debt coverage ratio, to about 1.5. So in the second year, we had much more. You could see here we have much more income in the second year. Why? Because we did some work to the property, and therefore we were able to start making payment. The value went up, so we're able to start making payments to the seller in the second year. So this is my proposal: $90,000 owed in full in 5 years, no payments in the first. We're paying the first mortgage down in the first year. Second year, $250 a month to the seller, and that's $3,000 a year. So $9,000 paid over 4 years to this gentleman, and the debt certainly was covered by the property. And here's what happened, guys, is that in the fifth year, the first mortgage would have been ballooned. So we owe the first lender $146,000. We owe the seller, the owner of this property, $90,000. This property, okay, will be worth in year 5 about $441,000. So we will have, our equity in this property in year 5 will be about $205,000. And over 5 years, it will make us about $307,000. But that's not important. What's important is that we have enough money here to pay back this and this to the seller. Okay, so that's really it's pretty simple again, and I hope you're ignoring all of these things because these are typically commercial expenses. And that's really it, guys. I mean, this was a really home run deal here because it worked out for us and it worked out for the seller. And you could see, I overpaid for this property by $278,000, what I believe. I think the appraisal came in at like, and I actually ended up waiving it. Oh, excuse me there. Yeah, I actually ended up waiving it, and I can't remember what it came in at, but it was so much lower. We overpaid by a lot, and it was still a win-win. Why? Because we're making money every month. The seller is getting paid. He's getting a good price. The banker is getting paid on his first mortgage loan. And in year 2, we've increased the value of the property by quite a bit. And in year 5, it's worth tremendously much more money. So, that's really it. That this gentleman was willing to wait, another 5 years for his $90,000, just so he was willing to wait a longer time to make more money. Again, if he was not willing to carry this note, the most we could have paid was probably, no more than $200,000. And this doesn't mean, guys, just because I put down $20,000 doesn't mean that that's the only money he got as a down payment. He received $168,000 in a wire transfer with the first mortgage. So the banker transfers this to the seller, and the only money that I am paying him over 5 years is the only thing owed to him in that time is this $90,000. So realistically, what he got down was 78, 88. He got $188,000 down, and in 5 years he gets another $90,000 with And this is interest only as well. So he's making out well here, very well. So I hope this illustrates to you how, again, how we were able to take a property with tremendous value add potential, overpay for it just because it cash flowed, it made money every month. So the lender was happy, we were happy, the seller was very happy. That's really the way to look at it. And again, just because this is commercial real estate does not mean that we cannot apply this same exact formula to your own house. So I thank you guys for watching. I hope this made sense. If you have any questions, you can reach out to me directly, 973-981-2131, or you can email me, Chase, CHASE, at re-merit, merit.com. And I hope you guys enjoy the next video, in which we will discuss actually sharing the profits with you in a deal and making you a partner. Thanks for watching.